Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. Adjusting journal entries. Adjusting journal entries are a crucial part of the accounting cycle. They are used to record transactions that occur at the end of an accounting period, but are not reflected in the general ledger accounts. Adjusting journal entries ensure that the financial statements are prepared in accordance with the accrual basis of accounting, which matches revenues and expenses to the periods in which they are earned and incurred, respectively. There are four types of adjusting journal entries: accruals, deferrals, estimates, and reclassifications. Accruals are used to record revenues or expenses that have been earned or incurred, but not yet received or paid. Deferrals are used to record revenues or expenses that have been received or paid in advance, but not yet earned or incurred. Estimates are used to record expenses that are based on a reasonable approximation, such as depreciation or bad debts. Reclassifications are used to correct errors or reassign amounts between accounts. Adjusting journal entries have a significant impact on the financial statements. They affect the income statement, which reports the revenues and expenses for the period, and the balance sheet, which reports the assets, liabilities, and equity at the end of the period. Adjusting journal entries also affect the statement of cash flows, which reports the cash inflows and outflows from operating, investing, and financing activities. By making adjusting journal entries, accountants ensure that the financial statements present a fair and accurate picture of the company's performance and financial position. Prepaid expenses. Prepaid expenses are costs that are paid in advance for goods or services that will be used in the future. They are recorded as assets on the balance sheet until they are consumed or expire, and then they are recognized as expenses on the income statement. Prepaid expenses help businesses to match their revenues and expenses in the same accounting period, following the accrual basis of accounting. Some common examples of prepaid expenses are rent, insurance, office supplies, and subscriptions. Prepaid expenses are a type of asset that arises when a business pays for something in advance, but does not receive the benefit of it until a later period. For example, if a company pays for a year of insurance coverage in January, but the policy starts in March, then the company has a prepaid expense of 2 months of insurance. Prepaid expenses are recorded as assets on the balance sheet and then expensed over time as the benefits are realized. This is done to match the expenses with the revenues they help generate, according to the accrual basis of accounting. Some common examples of prepaid expenses are rent, insurance, office supplies, and subscriptions. Unearned revenue. Unearned revenue is a term used in accounting to describe the amount of money that a company receives in advance for a product or service that has not yet been delivered to the customer. Unearned revenue is considered a liability for the company, because it represents an obligation to provide the product or service in the future. Unearned revenue is also known as deferred revenue or advance payments. Some examples of unearned revenue are: a customer pays for a 1-year subscription to a magazine, but the company has not yet sent any issues to the customer. A tenant pays rent for the next 6 months, but the landlord has not yet provided the use of the property. A client pays a retainer fee to a lawyer, but the lawyer has not yet performed any legal services for the client. When a company receives unearned revenue, it records it as a debit to cash and a credit to unearned revenue on the balance sheet. As the company delivers the product or service over time, it reduces the unearned revenue account and increases the revenue account on the income statement. This way, the company recognizes revenue only when it has fulfilled its performance obligation to the customer. For example, suppose a software company sells a 1-year license for its product for $1,200 and receives the full payment upfront. The company would record this transaction as follows: debit cash $1,200. Credit unearned revenue $1,200. At the end of each month, the company would recognize 1/12 of the total amount as revenue and reduce the unearned revenue by the same amount. Debit unearned revenue $100. Credit revenue $100. By the end of the year, the company would have zero balance in unearned revenue and $1,200 in revenue. The General Ledger. The General Ledger is a book where you record all the transactions of your business. It's like a diary of your financial activities. You can use it to track your income, expenses, assets, liabilities, and equity. The General Ledger is divided into different accounts, each with a name and a number. For example, you might have an account for cash, inventory, sales, rent, wages, etc. Each account has 2 sides, debit and credit. Debit means you increase the account balance, and credit means you decrease it. The rule is that for every transaction, the total debits must equal the total credits. This way, you can keep your books balanced and accurate.